Hello. Who've we got out there? Someone's waiting. Have you signed up? What's going on here? Can't access the video. Got a few gremlins to start with. I'll be back with you in a moment. Well, I'm just going to reload this because I'm getting the camera's just not staying on. We'll be back with you in 1 second. Hello, Residal. Hopefully I am back in the room. Is this all working a bit better? I hope so. Has anyone signed up for the competition? Starts tomorrow. It's actually going to be 100,000, 100K account that you're managing. Size doesn't really matter. It's about the return, top 30 positions. We'll walk away with those qualified account prizes. Something not to be turning your noses up at. Please get involved. Anyway, this is all about the preview. So let's have a look at that instead. Can find it. It's definitely Gremlin Day today. There we go. So the handsome fellow is back in front of you. Let's see what he's got to say. So obviously the big news towards the late afternoon session was in Japan with Ishiba winning the runoff vote. He was expected to lose to Takaichi, who would have been the first female leader. And she was quite dovish and sort of fiscally loose, whereas he is super hawk and wants to normalize policy. So we had a little bit of a sell-off in Nikkei futures, and the yen strengthened on Friday, and that just gave us a few wobbles and a few worries over the weekend. A little bit of that has been up and down today on the back of that. We've got China pushing with an 8% uptick in the CSI. And obviously, you're going to have a continuation of this anti-China, being short China, which you'll see in the Bank of America flow of funds was the second most consensual trade out there, of which everyone's been caught out, and they've gone literally nuclear on a typhoon of measures to try and kickstart everything. So Japan had been the kind of anti-China trade, and that's why it had been outperforming a lot at the start of the year until the carry trade unwind, and now you've got another reason to fade potentially a little bit of the Nikkei 225 and topics indices. Whether it's going to have a big effect on the yen will only play out over time, but it obviously makes it net hawkish. Even though we're dependent on US data, it means that they won't necessarily have a political obstacle in the way anymore for putting rates up. Just find. Hi, Andre Gallo. Hello, welcome. That is Dr. Reshinu, isn't it? Hello, mate. How you doing? So for me, the Nikkei is in a consolidation mode anyway. That sort of kicked it into gear looking for a 1-for-1 around 36,000 before potentially playing along with the rest of this global stimulus and putting in a new relative high. UJ is the issue. It sort of cements the fact now that we're probably going to keep going to sub 130 level, but it's the pace of change that we're interested in. And what I was saying last week is this looked like a consolidation before we move down again. I was looking for that 146.48 level. We wicked into it. The issue now is whether we get a double and we have another test of that before we come off. But net, it feels very much like this whole move from the top is going to do a double. And this was the end of, this will be the first WXY, and that'll be a larger degree W. This is an X, whether it's 1, 2, and 3, or this subwave is enough. And then we're heading down to this kind of 128 zone. Depends what we get from the US, really, in terms of pace. The Japanese have got to be careful about going too quickly with yen appreciation. A lot of their inflation at the moment is driven by the weak yen. They import a lot of the inflation, so they don't really want to nip that in the bud before they've actually got some endemic inflation in their system. We're starting to see retail sales come through as we did today. So net, they're on the right path. As I was saying, EU might be the most vulnerable given the data that's coming out to giving way earlier than other dollar pairs out there. GU is a standout basketball case, as the typo said there. And unless they find a way and an excuse to catch up with this whole global stimulus, the UK is probably set to be the outperforming currency in the short term. There's a lot of apathy still. A lot of arguments. The politicians are doing their best to not necessarily deliver the release. There's still a big issue about taxation and fiscal policy from Labour, and it looks like Labour are trying to change the rules on what qualifies. So we had the Liz Truss moment. Do we get the Rachel Reeves moment when the budget comes out? You know, I don't think we get the sterling collapse this time. We might actually see a sort of inflationary push and see people worried about whether we can actually do the rate cuts. So just keep an eye out for that. Aussie dollar, obviously they're super intransigent. They'd rather see people sell their homes than be rescued. They might have an excuse to keep that policy in place a bit longer if the Chinese stimulus gets the Aussie mining set all moving in the right direction. If you read through the Swiss update last week when they cut by 25 basis points, they've also dialed down their inflation outlook into 2027. So it looks like they've got plenty of room to continue cutting away there. I said last week was global PMIs. Within the pack, there is that chart I put onto Discord last week of who it was, everything apart from US services, and therefore their composite was down. The US was kind of strong in the services area. That might be something that repeats this week. We'll talk about that in a minute. The manufacturing numbers don't look like they're going to be very good at all, but there might be room as the week goes on for a little bit of perception that the dollar might strengthen again, and it is due to put in the end of a fifth wave short term. So that might all sit quite nicely. I know some people have been playing short gold today on that as a backdrop, and that has worked out reasonably well today. We'll have a look at 2 or 3 setups in gold just because I've been waiting for a pullback. We're obviously into one, and it's a case of trying to work out just how far that's likely to go. I have redrawn gold as well to include this, what looks like very impulsive, mega bearish scenario, and looking at a pullback in that context, just purely because it wasn't coming back. Ironically, I've probably gone early on that, but we'll see. So yeah, the China stimulus, left, right, and centre, monetary policy, they were criticised for not doing fiscal. They came out and did that. It's almost like they were just waiting for the market reaction, being described as a whatever it takes moment, rather like Trichet did in the ECB back in the 2009 period. And obviously Ben Bernanke had gone earlier with that, where they just bought all the bonds up, covered every base. It's pretty much like what China are trying to do. They are still worried that FDI, fixed direct investment, is going down the pan. And will this necessarily help them? There are one or two issues out there. They're sort of doing tit-for-tat retaliation against US companies if you're not buying local Chinese. Consumer confidence not helped locally in China with the retirement age being pushed up. So people are suddenly thinking they're going to have to save a bit more, not without splashing out. So we need to keep an eye on those sort of secondary factors, but up front, they couldn't have done much more from the sort of central bank and the party in terms of trying to kickstart everything. Effectively, they'll lend you money to buy the stock market. So September, we built it up. We talked about how positioned last week all the hedge funds were relatively short in stocks and how they were possibly running into a wall of money against that with the lower VIX and the buybacks and all that we were talking about last week. And we never got the half, unless we suddenly have a down 3% today, then we're going to have a positive second half of September, which is against the grain. But we did say that take out the big numbers, and that often is the case. Take out the big recessions. We've gone early. There may be a recession down the line, but increasingly, and I'll discuss it in there this week, is it not the case that we've had two supply chain issues with COVID and Ukraine? The inflation came through. We had the big rate rises into that. Have we not front loaded the pullback? Was there not 21, 22, the market effective recession, the slowdown, the great slowdown of the expansionary money? And since then, we're coming out of that. We're now feeling the effects of the rates. It takes 2 years to come through. But is there now enough liquidity and ballast in the system to just avoid the recession, in which case we're getting this soft landing idea that seems to be overly used at the moment. People are putting charts out there about just how much of a hit rate soft landing is getting, to the extent that it probably won't be the thing that happens. And the Fed aren't good at timing, but so far they themselves have done more or less all they could have done. They could potentially have gone slightly earlier. BMO were the first to jump into SPX and did an uptick in, what do we call it? In the target for SPX by the end of the year. Ubaid YT, hello, thanks for joining. So 6,100, and that sort of ties in with where I'm looking at. I think we can get to 6,000 with the current setup. There's a number of rallies that have taken place since October 22. And to me, the combination of those and how they would sit in subdividing, extending waves mean that everyone calling for the top at the moment just doesn't necessarily make sense with the relative percentage moves. I'll show you that on a weekly basis. That's why I think it's a buy the dip situation if we get any weakness into this first part of October. I mean, obviously today is the last day of the month and the quarter. I hate them. I don't like them. You tend to get ridiculous moves, not necessarily what we're going to get in the weeks ahead. It's just often what they call window dressing, people trying to make sure that they either leave room for a breakout from tomorrow, or they try to get things at the maximum valuation for the quarter. Depends who has the most at stake as to how those flows tend to go. So don't read too much into September the 30th moves in the market. To me, we've had a big rotation. We showed it last week, and that continued throughout last week as well a little bit. But what we did have was some underneath the hood. Again, we're approaching Q3 earnings season. The early markers for that, Micron and Accenture, which are basically AI infrastructure and AI bottom up, how they do it through companies, consultancy, etc. Both in rude health, both upgrading. So to me, that is probably a catalyst against already downgraded numbers for Q3 that we've had. So the bar to beat is lower, and there's every chance that we do that. And that is a fillip that gets us this October to December rally. But obviously, we've got a couple of geopolitical events to get through, not just the wars, but the potential for the BRICS to do something, at their conference at the end of October, and also you've got the US election. To me, we're having to try and second guess who goes first. Do the BRICS actually hold back and wait to see who wins in the US before they unleash the hell of the unit, or do they go early and try and scupper? To me, they'll guarantee Trump getting in if they release it early. So let's hope that's what they're looking for. And within it all, OpenAI made a big change of tack last week. I don't know if you saw it, but they're changing their outlook to be a profit-seeking venture as opposed to just throwing money at it. That will change things considerably, and they're trying to raise money. I think it's $6.5 billion against a $150 billion valuation for the company. So that is mega time, and people queuing up to give money apparently. So that's three major positives in that whole AI space. Does that bring money back into the underperforming NASDAQ? Keep an eye on that. Like I said, Goldman Sachs, they've put this is I'm slightly worrying about why mainstream investment banks and the media just don't talk about that BRICS conference. These are the major events supposedly affecting China markets throughout October into March next year. It's not even mentioned, which from the Vampire Squid is just incredible, really. When, never mind the NPC Standing Committee, it's the BRICS conference surely is going to be one of the biggest issues. And no wonder they're going early. They're getting themselves every reason to be a place where investment takes place. Like I said, I just discussed there about maybe we've had the exogenous, the outside shock that everyone seems to be queuing up to look at. This was a fantastic chart. I found a few good charts on LinkedIn again, and the CIS group, who collate a lot, had some wonderful ones. This was one that they'd picked up. And it's just comparing the Tech 2000 bubble to how the Mag 7 are now. And I just look at these metrics. The slightly bigger weightings in the index have got much more of an impact. So it's double the impact, but the amount of cash is more than double that all these companies own now. Their 24-month, 2-year forward multiple is half of what these crazy guys were at the top of the bubble. And look, profit margins are in the main. There's only Microsoft in the same ballpark as they were before. Everything else is double for the darlings, if not more. So that is telling you that these companies earn money. They've got cash left, right, and centre, and they're not at peak bubble ratings. So we haven't. To me, there's still a melt-up period to happen in the tech market, the NASDAQ, etc., as opposed to already being there. So just be careful of getting faded out of a lot of this stuff. I think we're only halfway through the bubble. And the other thing being large companies, international companies with loads of cash, sort of inelastic demand, then they are a deflationary hedge for what may have gone wrong in China. Now China's throwing money at it. That deflation may be offset by themselves. But either way, it's just another reason why portfolios will still have these large cap stocks thrown at them. Crystal FX, any free account? Not at the moment. No free accounts yet, but we are in the planning. We're going to start doing some free accounts based on questions on what is in the preview or the live show, and we'll start backloading those and give you an opportunity to win some prizes and accounts, but it's not set up yet. But that is something that's coming. Obviously, get involved in that competition. There's no better competition on the street than the one we have. You go straight to a qualified account if you manage to be in the top 30 places. So make sure you get yourself involved. Boom, boom, boom. Right, where are we? So SPX, that's started to get a little bit choppy, but I think 6,000 is a potential. It's not just a crazy number from BMO. We've had over 40 plus all-time highs. But I just think there's more subdivision, which I mentioned earlier. If you go back to that 22 pullback, we've got reasons to think that there are bigger moves ahead. Like, for instance, the first time we booed off the big sell that was being called in January 23 was that middle wave. As soon as it passed 11.75, we knew that we were in a subdividing wave there, which again subdivided. And we've got lots of small numbers surrounded by two big numbers, makes it very difficult. The only time we've got three waves in place here that could be topping out is from that starting point, which would be a valid one where the middle wave isn't the shortest. But again, that seems an odd combination from here with a very small relative pullback in sort of late December, January this year. Didn't really count. The bigger sell-off really came around the April sell-off, since when it's a moot point whether we've had enough subdivision in those waves. To me, they look better as a single wave, a wave two, and then since then we've been chopping around, subdividing, and I think this has much more to go to get up here and to actually put in a final subdividing. And it, because these things have started to overlap, that could well be a short-term fifth wave leading up into here. Now, generally, I'm looking at the fifth wave and the first wave of the whole move to be a similar percentage, and that's what we're looking at here. I've estimated 18.5% to match that. So if we finish in the same way, 6,000, 6,100 that BMO are talking about is a rational sort of wave progression to expect. This just all seems incomplete to me, the way that we've got the subdivision set up. Doesn't look like we should really have rolled over here properly if that was the case, but we've now continued putting in multiple all-time highs since. I think there's more juice left in it. The usual daily throw everything in it chart showing the same sort of thing. As we mentioned last week, we're starting to get decent volume into this breakout, which we hadn't previously had. And people are telling me that there's extreme measures of stocks above 52-day moving averages, blah, blah, blah. The number of stocks that are now above the yearly move for the S&P. They're saying that means that we're going to top out. Well, I think it shows you that we're broadening out. And here we have the number of stocks trading above their 50-day moving average is still only at 80%. The tops have always been 90%. We're not at the top line and get scared level of stocks above their 200-day moving average. So it feels like we've still got just enough juice to give us that one more big push out. Short term, obviously, oscillations within this. This first week of October has got a lot to get through in terms of the job numbers, but the net direction of travel and the expected Q4 rally, I think, is enough to get us up to some of these magic round numbers, which a lot of the indices have got in front of them. Nasdaq has been a sort of ones and twos nesting for a while now, looking for a breakout, and it's sort of been struggling to do that. But since we hit that August the 5th low, look, we talked about the 1 and 2, 1 and 2, 1 and 2, perhaps just trying to put in another new short-term low for the move here. Currently, just because I'd like personally to see an equal legs sell off, if not just a tiny bit more to put that in. So I wouldn't rule out a test of the 200-day moving average again down there. And off we go, starting to unwind the 3, 4, 5s and put in that sort of 22,000 top for the move. That's where I'm looking at, which gives us another almost 10% upside into the end of the year. So that's where I'm playing. Throughout this, there's going to be consolidations and pullbacks, but I think the direction of travel is still to get the Nasdaq to be the last one to catch up as the money rotates back into it. We said it would likely underperform as we got broadening out, purely because the heavyweights were going relatively sideways, and that has proven to be the case. It's beginning to catch up. Remember, we said the Mag 6, and even Tesla helped the Mag 7 last week, just having a little bit of a combination challenge, but that's consolidating, and I'm looking for the next up leg to come. The Dow, obviously, the Dow is an awkward index with its with it being price changes. The bigger the price, smaller moves have an outlandish effect on the index, and obviously, likewise, a smaller price stock can have a bigger percentage move and have less of an impact. So you've always got to be aware of which stocks are more likely to be moving. But again, its direction of travel has been the nesting ones and twos for a while now, and that one has been just like the S&P driving us up. Again, I'm looking for a little bit of choppiness in the direction of travel. 43,000 should get us a reasonable potential pullback. But again, I'm looking for it to be, held 41,000, maybe 42,000, somewhere in this overlapping area that we're currently playing around in. And then again, the final breakout, will it get to 45,000 or not? And we'll have a look at gold now, which I know a lot of you are really interested in. Just let me check something. Brilliant. And to me, you always need to be looking at inflation and gold as it's the debasement and the money supply, and anything that makes money loose or the money multiplier effect go up. And just basically seeing your money sweated and the money growing is what evidence you're looking for. Liquidity boom, and we're getting that from the west and the east at the moment. So by definition, that's a lovely backdrop for gold, and it's in the commodity space, which China underweight, and it was underweight commodities as an investment. People diving back into industrial and precious metals, blah blah blah. So unstoppable up crash for gold last week. Silver equally putting in a new high for its rally. Now we've started consolidating today. China has gone into Golden Week. Does that mean that punters will stop buying gold? Not necessarily, but the markets aren't open, so it's difficult for us to see what is going on there. US wise, will the rates keep going down? Well, just as we're trying to show last week, the real rates is the argument. There's a couple of ways of looking at it. You either look at nominal GDP for the read through of where rates should be, and they're not a million miles away, but in terms of Fed funds minus inflation, and with PCE coming in at 2.2, that means that real rates are 2.8 at the moment, being around 5%. Anything above 2 is tight. They'd really want to be around 1%. If they're being honest, so somewhere around 3 to 3.25% is where we're heading, if not lower. So rates will keep being cut unless things get in the way. So I've been saying I was looking for pullbacks in gold, just couldn't get them. And I said I might have to redraw what I thought was the topping out. Extending wave, I still think we're in minor wave 3, but it's this wave 5, which is incessantly moving up. Now we've started to get a pullback, and it has been an equal legs, but I don't think it's enough to be the subwave 4 potentially, because that should really be a 23.6, 31.8 pullback, and we'll look at that, and it really didn't happen. So I was kind of thinking if the overbought conditions short term didn't hold, and I'll show you the chart for that in a minute, then we'd probably go lower. And so it's proved. So one or two people have been saying, including you, Dr. Vishnu, that they thought it would hit the 2630s, and we're in that, aren't we? Not quite sure where we're at the moment. Let's have a look. So around 2640 still, we're bobbing around, aren't we? So the makeup, I've gone back to where the 1 and 2 was for the minor waves, which was way back around December, January. We'd been looking at this 2.618 for ages. Remember, I'd said that was potential for us topping out here, but we've just carried on grinding up. So we have to bring back in a 3.618 fib, because this is obviously one of the waves that does most of the work, the minor 3, and it is obviously in extreme fib extensions. So how about putting the 3-spot 618 back in? And then if we did have a significant subwave 3, I've moved my subwave 3 from here up to this current positioning here and drawn in Friday's pullback as the potential wave 4. Now, that is the midpoint of the whole range of this wave up, but in terms of where the 2, 3 and potential 4 would be, I've drawn a parallel channel between 2 and 3. That just happened to line up with 4. Again, look out for computers putting in Elliott wave theories, etc. And not surprisingly, we've bounced off that. And then that was the sort of 2640 area. We're now playing around with it. From that, again, on the theory that with an extending wave 3 in the middle, wave 1 and wave 5, most of the time equal. So again, 5-spot 3-1 expansion from that low takes us up to sort of 2780. So I've got a nice confluence there, 2760.80 in a channel that hopefully winds its way upwards, takes out 2700, and we finish in there. And that would be an overthrow of the 1 degree lower 2, 3, 4 and projected 5 channel, which is this red channel down here. So you tend to get overthrows at the top, and then we'd be looking for a proper wave 4, which probably comes back down below 2500 and the bottom of that preceding channel. So that ties up a little bit more of what's been happening with how the development could go. And this does look like there's a 5-wave proper swing that finished on Thursday night. Now below that, I put in 2 or 3 others. We put it on the daily basis. You've got the same sort of scenario. And again, that looks a lot more like an extending 5th wave within the 5th wave, which has got one more daily breakout scenario to do. It's just a case of finding where the test back comes. It could easily hit this 10-day moving average. Wouldn't take a lot to do that. We've only been extended for a short time. Even the 50-day moving average, which tends to really hold on gold. So that could be an ultimate pullback to the 25 level. But I think within this structure, that would start to cause issues of overlapping. But again, because it's a 5th wave, you can have overlapping ending diagonals. So all of that is still possible. But I'd like to think that the momentum stays in there with all this liquidity and the China upwards potential and the potential worries, geopolitical. Israel are desperate to get someone to fight with. America's not really moving out of the way. Still sending weapons to them in the Ukraine. So there's big moves afoot geopolitically, and obviously we've got what's going to happen from the BRICS. So I'd like to think that we break out first before we put in a proper serious pullback, mainly because I expected that all to happen in here, and we found a new level of breakout. And the thing that was troubling me, we did have an equal waves bounce off into Friday session, but the grey channel here is the 23.6, should be 38.2 fib, classic fib zone. So if we're going to do a double correction, that would make sense. So that equal legs would hit somewhere around 2600, and then we'd be off to the races again. So just be careful of buying within here, going all in, and try and factor in the fact that we may be having, and we've obviously had today, a breakdown of this, which suggests that it's more likely that it is actually playing out. And we'll look at that chart live in a minute. So allow for the fact that we might get one more little pullback before we go. And the most bullish situation was overnight coming back, and it did have another challenge of this upward 2 standard deviation, 3 standard deviation channel. It's the 1 to 2-1 that keeps it in the bullish phase, and that broke down fairly early today, mid-morning. So we've actually come down all the way into the 40s and 30s. It's gone into the sell signal zone of the Bollinger Bands. So if you do look at the Bollinger Bands for short-term moves, we're looking for escape back up. We'll have a look at that in a minute, see where we're sat. The other thing to be aware of, CFTC data for last week was out, and obviously net long speculators, not hedges, etc., was at long-term highs. Look at the last 20 years, and we've only been here as high twice before in terms of outright open interest speculators. So we are at quite extreme longs, and we are very much nearing a topping out position. Like I say, it feels like there's probably one more squeeze left in it before we put in that proper consolidation. But be aware, as always, make sure we've got stop losses in place. These things can turn. Oil, again, that's been trying to break down, had a bounce back, been rolling over again. Will the Chinese activity come back? That's what we hope from all the money that's being thrown at it. The Americans are getting their cheap fuel. OPEC are throwing the towel in. They're coming back. I did say, didn't I, 6 months ago, that I thought they'd made a mistake trying to price fix and that they were going to hand over the supply to America. That's turned out, and now they're coming back with the price much lower, and they're just going to add to that. They need to get some money in for the block. So it's highly likely that we're still in that downward trend for oil. And every time we get a bounce, we'll probably see that faded. So we touched on all that. Another reason for the NASDAQ and NVIDIA and the likes is that Jensen, the CEO, Jensen Huang, has sold 713 million of stock throughout this churning period. And yet the stock has held up and returned back to sort of $120. He said he stopped for now. Stock's at 3 weeks high. You've got good info coming out underneath. Pullbacks are probably a lot lower now, a lot shallower than we thought they might be while he was still selling. And then Germany, if things were going down the pan, what on earth is Germany's DAX doing at record highs while the economy is down the bottom? That is the discounting mechanism taking place. Interest rates will be coming post haste from the EU, despite a lot of their dithering around. They may even convince themselves to do it in a couple of weeks' time. If not, they will do 50 in November to catch up. Those rates are only going one way until they come out of the doldrums. Both their PMIs were poor last week, and there's little sign elsewhere. But remember, Germany have got themselves very tightly aligned to the Chinese recovery, the Chinese economy. So if they do recover, this is the reason why the DAX is one of the front-running indices at the moment. So in terms of how I've been looking at it, again, it's been one of those 1-2 indices, lots and lots of 1-2s. Looks like we're about to have the folding threes. We're in a small pullback, should have a new all-time high, then a pullback, and then again push on 20,000. Looks like, as I said earlier, a key metric for the DAX index, which again is only 5% away from where we are currently. So I think we're going to have a lot of bell ringing going on in the next few weeks, if not a couple of months. But stand by, a little bit of churning along with the other indices short term, generally pulsing to the upside. FTSE 100, that was the one that had really been churning. I've redrawn the churning to be extended to the extent that the August low was the wave 4. And again, that one has been putting in interesting consolidations, because that's an expanding flat where it has an overshoot high, which wasn't actually the high for the move. It was part of the consolidation. But we've still got 1-2s. That 2 low there, 8 to 150, hasn't been taken out. And even if it does, that's probably a further extension. It's the August the 5th low, which is the key one. I think net we grind up, and with the stimulus coming via China into miners are massively heavyweight in the FTSE index. So despite the apathy from investors and politicians, the UK 100 may end up grinding to new highs. So this is one of the good charts. If you ever get the chance of seeing the Bank of America weekly flow of funds, It's brilliant. And as people saying, long Magnificent 7 was the consensual long, but that has been coming back for 3 months now from the July highs, blah, blah, blah. Short China equities right up until last week was the second most consensual position. That's going to be unwinding at a quick rate and has been. And then gold, with people not believing the outbreak, it's suddenly gone super consensual into September, and we've continued to break out. So that was really telling us what was going on. People have been buying into bonds going into Jackson Hole and the Fed decision at the short end. But there's a lot of potential that they've overdone that now. So be careful of that suddenly becoming unwound. It's not really got a lot further to go unless the data becomes really bad, in which case it'll remain a place to hide. But, you know, like a lot of people are expecting this week, could end up being a draw in the data, which might just make rates back up a little bit, the dollar back up, and hence bonds may underperform. This is one that's telling you be careful of the outright recession trade. People are going overweight, or at least back into long corporate bond positions. So they're not seeing any credit risk really there. They're seeing the interest rate boost, and they're not expecting big recessionary outcomes. So that might just suggest that the Fed will be on this nice smooth path of normalizing rates rather than having to fight recession. But we'll look at some other contrary data to that in a minute. And obviously short Japanese yen throughout the August carry trade unwind into September, getting lower and lower. And the fact that it's almost totally unwound, was that a nod to the fact that Ishibu was going to get in? If Taikichi was going to be the winner, you'd have expected people putting on the short yen trade again. So maybe the markets do make a good consensus after all, but it's definitely a good place where you should be starting your thinking, just how to place your macro bets and then work around whatever that consensus is to start with. But it gives you lots of discussion points. I always think it's a great starting point to know where it is, and the market is always reactive when the Bank of America flow of funds data comes out, gets announced onto Bloomberg as a live ticker. So, because I'm in the PDF, I'm not seeing your questions. Let me just see if you've got any. Just move that up there. Dr. Reshu, 2635, you got out. Yeah, it is very volatile, as you expect after the whole move, and I'll have a look at it in a minute with you, because I think, you know, these equal legs, when they extend, the second leg, I often look for spot 618 as well, for being a turning point, which it's not a million miles away, I don't think, from having done that. So do I trade all the markets? I certainly look at them all. I jump in and out of things that I think might be of interest. Of late, I've mainly been gold and NASDAQ and a little bit of FTSE. I've got silver at the back of my mind rather than gold if we're going to go again, because that should really be catching up. Sometimes bonds. I've played bonds a bit in the past, not been playing that at the moment. Don't normally touch the currencies a lot other than messing around in the systems. I don't normally put my money into FX, or I do analyze it for you. Germany's a good one to play around in. The DAX as an index. And I keep trying to get myself to play the Nikkei, the N225. But I like the charts. I just don't like how the price moves. I've just got to get myself used to how that trades. So yeah, this week, how are we looking? And there's quite an interesting chart in here. So if you're watching or playing NASDAQ last week on Wednesday, when the conference board data came out, I think it was Wednesday, market completely dropped out. And people thought it was because the conference number missed by a long way, but excuse me, I think it was the data underneath, which is what people look at which was their employment data, and they talk about the jobs plentiful index. And this has been around for years, but there's a massive correlation between the US unemployment rate and the jobs hard to find minus plentiful. So when whatever the balance is, has a big correlation with the movement in the unemployment rate. Now you can see that had a big jump out there last week, just in line with how the unemployment rate has been moving. The unemployment rate tends to lag that more leading indicator. So it's going to be interesting. So everyone says once that the unemployment rate in the States turns, it tends to keep going. It only pulled back last month because it had been a bit of a rounding anomaly the month before, and we didn't have the drop through. But if we get a negative print or one back below 100,000 on non-farm payrolls, and obviously we need to see what the revision's like to that unexpected jump last month, then that could easily be back off to races 4.3, 4.4 unexpectedly, and it'll be panic on again. So Albert Edwards is Dr. Doom, Mr. Ice Age, predicted the GFC brilliantly. That's something that he shoved out again last week. Some of his old colleagues reminded him that he's been using that for years, but quite rightly, because look at the correlations. The only thing missing is whether we've got a recession. As I said, it might well be that we've had it. On countback, we might actually have a recession put back into that sort of 2022 period. That does sometimes happen. You never know. Economists do have a way of protecting themselves. Anyway, this week we're going to have JOLTS. Remember, that is looking at the August data, not September, and looking at how the trends were there. Again, it'll be all about, you want to be looking at the quits rates and the fire and hiring rates, rather than necessarily the job opportunities. The job opportunities are good when the market is buoyant. Employment-wise, we're now in reverse, so it becomes less important of a number, even though it will be. We'll have a read through to the market's reaction. We've got ISM manufacturing on Tuesday now. Again, when the Seaboard Conference Board's consumer confidence came out, we had Richmond just after it, Richmond manufacturing, which missed, and the unemployment factor within that missed by a mile. We've been seeing that across all the manufacturing prints. So Tuesday is likely to see a sort of panicky bit of data with manufacturing employment weak. JOLTS may have some panicky hiring numbers in it that might get people a little bit worried, although the total private went down, but the total non-farm payrolls went up. There's a bit of a mixture in there. The JOLTS looks at the data that goes through the non-farm payrolls and confirms its own report. So just look out there for anything really anomalous. I'll try and have a look myself and point it out. But the household report has been where the truth has been. That's not been missing at all. ADP is on a 2-month streak of predicting the private payrolls correctly, i.e. lower than expected, and then it's come in as a miss in non-farm payroll. So will that continue? Initial claims been going the other way. The 4-week average, and I've got some great charts in the pack just below here. The actual numbers back below 220. The 4-week average is below 230. So James Bianco is on my LinkedIn list, owns Bianco Research. He's saying weekly initial claims, look, they're trending down. Where is this big negative for unemployment? And then so if you actually look at this on a 50-year, 4-week rolling average, the reason we talk about the 4-week rolling average, because it tends to top out when you're going into recessions, etc., starts going up into the recession, tops out towards the end of the recession. At the moment, we're at a complete opposite end of the scale. We're at, cycle lows, and yet we're telling everybody that employment's about to go through the floor. So that is a bit of a contraindicator. Listen to the economists that are talking about it. They keep saying it's coming from a strong basis where we're seeing this roll over. So it might not be as bad as what people are making out. The Fed even are only talking about 4.4%. So they've missed their number of 4% already for this year, but it's the slow decline that we need to keep an eye on. They're really in a path of wanting to equalise rates against inflation, and they're using jobs as an excuse to get started. But this isn't necessarily the road crash that everyone thinks. That's why you need to listen to the rhetoric. It's not a panic either if unemployment doesn't go through the roof, employment falling off a cliff. As long as the message stays secure that they are normalising rates. And so we've got Japanese industrial production missed today. We talked about that. Retail sales beat. So Chinese PMIs and even the Caxim ones, they're the most accurate ones, the private ones, and that was downbeat. So the stimulus came at the right time. You get the feeling they knew those numbers, and hence they were throwing everything at it. GDP unexpectedly ticked down for the UK today. No one really understood why. That might just help kickstart the Bank of England to playing catch up, etc., etc. Just Chicago and Dallas activity to come. China starts the Golden Week as of now for the rest of the week. Loads of activity surveys coming out. Mainly, though, it's the market PMIs across the globe. And I said US jolts. US Atlanta GDP now. So America falling through the floor. That upticked again on Friday's read, up to 3.1 for Q3. So it's not a disaster yet. Remember, Economic Surprise Index, that's another one that is ticking up versus the Fed having taken out the insurance cut. And then we go into construction data at the end of the week, but really it's non-farm payrolls that we're looking for. The ISMs are Tuesday and Thursday this week, because that's the 1st and 3rd of the month. There's very little on the earnings front this week. Carnival may well be out already, I think. Nike coming out during the week. There's nothing really of much interest to note. A few consumers, etc. But no, it's pretty dull. Talking heads wise, he must have already done it. But Michelle Bowman must have spoken. Lagarde as well. And Powell has obviously got comments tonight, hopefully more interesting than those prepared ones the other day. Tuesday, absolute full slate, as is Wednesday, various areas, and it quietens off into the end of the week. Another Bank of Japan guaranteed to be hawkish comment. Pilley's out a couple of times, Bank of England economist this week. Williams doing his usual review of non-farm payroll scenario, but it's fairly quiet after that. So employment, load of talking heads. You've got all last week's stuff there. I hope that was useful. I hope you got some questions. I'll just quickly look at that gold chart we were talking about. So that if we look at Friday's lows being the low and go back to that high, and that brings back in 26.22. But if we put in the spot 618, then we've already done enough for that to qualify as being in the kind of true consolidation valid end. Anywhere in between spot 618 and 1 is a turning point. So just be careful about getting too bearish down here. We've talked about that is actually now into the grey zone. Might have a little bit more to do, but we're overall starting to get into the confluence zone for the bounce. But it is very volatile. We keep jumping between this 33-40 kind of zone. We've obviously got a two-way pull. Some people are talking about the RSI being quite overbought, I saw, but MACD is negative at the moment in my chart on the hourly basis. What are we looking at daily? It's daily, isn't it? So you look, RSI on the daily basis is extreme, but it isn't. It's actually negative on the hourly basis, which you'd expect because we're now selling off. So you've got to marry those two together. We're back below the line in RSI terms. I'm not really that interested until we're above 70. So it's still not totally overbought. And even then, 2080 tends to be the extremes. For RSI, MACD, again, it's at a high for the relative move. So that doesn't look like a wave 5. To me, it feels like we need another wave higher with a lower MACD. So that sits kind of with my expected breakout idea. But short term, it is in a tricky zone, and we'll look at the Bollingers just because it's struggling to get out of that lower zone. So the extreme ones are the 3 standard deviations. They don't normally go in there and stay in there unless there's a reason. It's generally the upper bound between 1 and 2 and lower bound between 1 and 2 standard deviations. It's fighting. It's trying to get out of this lower standard deviation. Remember, it needs to be 2/3 really to qualify, which it didn't quite hold on to in the previous 15 minutes, came back into it here. So we are flip-flopping. We need to see where this ends, because if we come back into this lower band and stay, then we're probably going to get a breakdown towards the 2620 zone of that fib grey band we were just looking at. So quite important two-way pull at the moment, just to see whether we get another % of downside, but it is trying its best to dig in. At the moment, it's a no trade really until that holds in here for a few candles and etc. It's just too flip-floppy. Was I trying to catch a falling knife? I know that's you talking to Razadul. My stop loss got hit. Yeah, well, I had where did I have one in? I was taken out in this 2640 level. I thought that we would bounce off from the oversolds, and we did, and then we went back in, and I got nailed here at about over lunchtime. So that was quite frustrating. Just leaving it alone now until we make a proper break. You can see it's a 1, 2, 3, 4, 5 on 5 and 15-minute time frames. So you've closed out, haven't you, at 26.35? But net, I do think we're just in a small kind of consolidation at the moment. It's just a case of trying to nail it. We've been looking to find a good, decent 3-way pullback to be able to move into. We've just got a little bit of froth coming off it. Is that literally the Chinese not being around? It's the end of month, flows across all assets. I don't think there's a carry unwind going on in UJ particularly at the moment, because in fact we've been going the opposite way, haven't we? If you look at UJ up to date, we have been digging in, and I think the Nikkei jumped as well, didn't it? And even the Nikkei bounced off that initial markdown, so I still expect the Nikkei to put in one more little surge down before we go again. It doesn't have to be that far, just needs to be a new lower low for the move. Yeah, well done, Reshinu. You and Gustav got it nailed, didn't you? Absolutely brilliant move. So these two are chatting on my chat earlier and suggesting that they thought there was a sell zone coming, and they caught a very big downdraft very quickly. So they played very well. Didn't look at the dollar chart today, did we? So that dollar chart is playing in that sort of contracting channels, really. And to me, that could be a wave 3, but I think it's an smaller degree wave 1, wave 2, and we're grinding our way down again. As we said last week, I want to see a break of 100, down to 99, maybe with a bit of luck, and then a bounce back. We could, again, still have a little short-term bounce back this week as we work through the data, a bit of flip-flop. But if anything, like I said, manufacturing is at risk of giving us a little wobble tomorrow. So it might be that we come down to challenge here, stay in the channel again before we finally break through and down a little bit later in the week as things, like I say, work themselves through. There's going to be lots of knee-jerk reactions in the dollar, which can put these things in short term before we get rallies. And we are getting quite long in the tooth of all this winding down. This eventually will be a 5 waves here, which is due a decent consolidation, a couple of percent. And then we'll see what the real action is. But for now, just on that basis, we're only dealing with 1% and 2%. We said last week, and this ties in with the short-term bond market, potentially the forward curve being up to speed doesn't leave a lot of room for maneuver for reactions from the dollar to the economic data. It will feel like it in the immediacy, but net it hasn't got a lot of runway left because the prices are up to date. The Fed dot plot has given us 2 years of a downward trend. So it's going to take a lot to unwind that. In fact, it's going to take a lot for us to be impulsive down unless something mega happens. They have to, speed up the 50 bips, if not 75. So confusing Monday because it's the end of the quarter. I'm slightly complacent about still needing future highs on the indices, mainly because of the setup. It's difficult to fight the wall of money. Things are slightly extended, but there's still room for one more breakout. That would complete the 3, 4, 5s we've been talking about since the sort of Q2 April scenario. So we're in the latter stages of that, and we are going into the seasonally strong part of the year. So now, whereas we were scared of fighting the downside and being aware of it, we need to be careful about shorting too aggressively. Despite what people are saying, the wall of worry, we've got potential upbeat earnings season to come as well. So be very careful about taking on this last outbreak for the market. There's plenty of time to start panicking about the levels once we know who gets in the White House. But net, I'm looking for the buy the dip scheme to come into play in most of these indices, and there's some very big round numbers that they're heading towards. So play it safe. Look to buy gold as well. That move's not finished. Like you said, sterling is probably the one that outperforms. The EU has potential for collapsing quicker than expected. Aussie dollar should be all right. Swiss franc, they're trying to get it lower. Be careful of taking that on too aggressively. But, bob and weave this week is going to be a little bit more volatile. The VIX may go up as a result short term. That can get you the small pullbacks we're looking for in the indices. And then Shamborsi moment. Come on, dive in. So if you haven't got any more questions, good luck. And I'll try and catch up with you on Friday. As ever, if you found that useful, give us a big like and post any comments on my chat or on the YouTube, and someone will try and get back to you. But if not, remain safe out there. We haven't got to do it all today. Spread your trades. Thank you, Residol. Good to see you and speak soon. Bye.